Investing in the markets sure would be easy if we could expect them to always move higher. But that's not reality. We've all seen or heard of market downturns, and it's better be prepared than to be caught off guard. I'm Scott Connor, a 30-year veteran trader, and you'll learn about handling market downturns right here on Virtual Trade. Welcome to Virtual Trade. In this episode, we'll explore different types of market downturns and some ways that technical analysis can help you manage them. We'll then turn our focus to some lessons we can learn from past downturns. And finally, new trader Jenny Horne and I will concentrate on assessing her new portfolio's risk. So take your seats and grab your notebooks, because it's time to dive into understanding market downturns. From time to time, the stock market experiences a downturn. Now, these downturns can vary by length and degree. Downturns might be short-lived and relatively harmless, while others may be considered long-lasting and severe. Now, in this episode, you'll learn about the different degrees, how to identify each, and how to potentially manage severe downturns. Now, typically, investors watch for downturns by monitoring a major index, such as the S&P 500. The degree of a downturn is typically determined by how far the S&P 500 has fallen from a recent high. If downturns become severe, you may want to take defensive measures. If you spend enough time flying on an airplane, you'll experience turbulence. If you're new to flying, it can mean a feeling of helplessness, uncertainty, and fear. Well, this is also true in the markets when we experience downturns. If you experienced a market correction, you may have aligned your investments in accordance with specific objectives or taken protective measures. Now, this helps with emotions when experiencing market volatility. Now, let's take a closer look at identifying the different types of market downturns.
There are generally 3 degrees of downturns. The first is a minor downturn, which can be categorized as any time the S&P 500 has fallen less than 10% from its high. Minor downturns are quite common, and technically any downward movement at all is considered a minor downturn. If the S&P 500 falls 10% or more from its high, it's considered a more worrisome downturn. A drop between 10% and 20% from a high is considered a correction and is fairly common. The most serious downturn is when a correction turns into a full-fledged bear market. A bear market is when the S&P 500 drops 20% or more from its high. The risk in a bear market is that the S&P 500 could continue dropping and drag most stock investments with it. The S&P 500 has dropped more than 50% during some of the worst bear markets. For instance, during the financial crisis in 2009, the S&P 500 dropped 52% from its high. The goal of identifying and measuring downturns is to try to limit losses. In addition to monitoring the S&P 500's highs, there are 2 other ways to identify and measure downturns. The first is identifying the S&P 500's long-term diagonal support levels. A break below a diagonal support level could mean that a downturn is becoming more serious. But this technique has its limitations. Depending on the locations of diagonal support and recent highs, the S&P 500 might already be in a correction or even a bear market by the time it breaks diagonal support. A more dynamic way to identify and measure a downturn is by using moving averages such as the 20, 50, and 200-day. The 20-day moving average tracks the S&P 500 the closest. Generally, the 20-day moving average is no more than 4% away from the index. This means if the S&P 500 breaks down below the 20-day, it can be an early indication of a pending correction or a 10% drop. The 50-day moving average tracks the S&P 500 less closely. The 50-day is generally anywhere from 4 to 8% away from the S&P 500, although there are times when it's more than 10% away. If the S&P 500 falls below the 50-day, it can be a stronger indication of a correction. The longest moving average is the 200-day. This moving average is probably the most important when it comes to measuring a downturn. If the S&P 500 falls to the 200-day moving average, it's probably already down 10% from its high and in a correction. That's why investors pay special attention to the 200-day. A breakdown below this level can lead to a deeper downturn and sometimes indicate a bear market.
So to recap, market downturns can vary both in length and degree. There are 3 types of downturns: minor downturns, corrections, and bear markets. Now, identifying support levels or using moving averages can help you recognize market downturns. Now, let's take a look at how to potentially handle a market downturn.
First, consider your time horizon. If you have a long time horizon of 10+ years, then you may not need to do anything at all. However, if your time horizon is shorter or if you want to take defensive actions, then here are a few tips. The first and simplest way is to reduce your exposure by selling your stocks to a level that's consistent with your risk tolerance and keep the sales proceeds in cash. This might include selling a portion of the stocks if the S&P 500 breaks below its 50-day moving average and another portion if it breaks below its 200-day. The risk of selling these investments is if the market stops falling and starts moving up again, you miss out on the upswing.
As we wrap up, it's important to remember that identifying your time horizon will help you decide how to respond to market downturns. Now, reducing your exposure by selling stocks is an easy way to help manage risk. And the risk of selling these investments is the potential to miss out on any upswing. Welcome back. It's time for Tools of the Trade, where we look at various tools within TD Ameritrade, Thinkorswim, and Mobile Trader. In this segment, we'll be examining past market downturns on the Thinkorswim trading platform. We'll be using the charts to do that. Now, what we want to do is develop a better understanding for historical market corrections. And we'll also be using a long-term moving average on a long-term chart to help us identify when market weakness appears. Now, before we jump into the software, remember that we'll see markets moving up and down quite a bit. Now, when we get small moves down, those are just part of the day-to-day process of the market. But when we do get a 10% move down, we refer to that as a correction. And if we get a 20% move down, we refer to that as a bear market. Now, let's get some historical perspective by jumping into the charts on the Thinkorswim platform. We'll go into the charts. We'll put in S&P 500 because we'd like to look at the overall market benchmark, if you will, and that would be the S&P 500. I'm going to hide the left sidebar by clicking on the icon here to give us a little more room. I'd also like to start out by giving us a longer time frame. Again, we want to get a historical perspective on market upturns and downturns, the duration of those turns, and the degree of those market downturns. So let's take it out to a much longer time frame. I'll click on time frame. We'll keep it daily, but let's take it out to 20 years. That should give us some good perspective. I'll hit OK and let that update. So now it's putting in all the information for the last 20 years. Let's add a simple moving averages to this as well to see if there's any kind of correlations we can see with these market downturns. Let's go right to the studies. Type in simple moving average, S-I-M, well, there we go. I put in the first three letters and it appeared right there. Simple moving average, highlight it. Add that to our study set here, and you can see right there, simple moving average. Now I need to edit this because right now it's a 9-day moving average. Let's hit the little icon, go to the length, and we're going to change this from 9, obviously, to a much longer time frame. Let's put in 200. That's considered a long-term time frame. And then down below, let's make this just a little bit wider, maybe a 2, and hit OK. Now that'll give us. And now we're all set with that. We've done some edits, hit apply and OK. And now you can see that 200-day moving average in bright blue here. So let's do this. Let's put an example of some past downturns we've seen in the market. Number one, let's go to 2000. Let's jump to that first market downturn and take a look at what we saw there in terms of degree and duration. As you can see, the market peaked somewhere right around here, late September, August of 2000, and the sell-off continued all the way into late 2002. Now the duration here, about 2 years. Let's get an idea of what percentage decline this was. What was the degree of the decline? I can simply do that by left-clicking at the bottom. Now again, I've gone to the drawings and I've selected a drawing tool of trend line. So I'm going to put that trend line in there. So let's click on that. Go to the low point in the market that we saw right here. Left click one time. Take it up to the high point. Well, I think that was actually a little bit earlier in the year, but we'll go there. Take a look in that box at the bottom of our trend line. It says minus 50.1%. So in terms of degree, this was a 50% sell-off in the market, well beyond a bear market, which is only 20%. Next question that comes along, now that we know that was 50%, is what was the duration? How long did it take the market to get back to that level? Well, again, let's go back to that high point right here, and we're going to make a long-term trend line. We're just going to make it flat here, and what I'm going to do is left-click on that. Now we have a trend line, but what I'm going to do is right-click on that trend line, and let's go ahead and edit the properties of that trend line. What we're going to do is extend on the right. So on the right side, I'm going to go right extension, turn that on. So it'll continue to extend to the right. And again, let's make this one just a little bit bigger. We'll make it a 2 and hit OK. Now what we're able to do is extend that line to the right. Now what I want to do is go from 2000, the year 2000, to the right until the market gets back up to that red line. And here it was in 07. That was a 7-year recovery from that 50% sell-off. Now let's do the same thing. Get rid of that line again, right click, remove that drawing, and let's go to another one that we saw more recently, and that was the 08-09. That was the housing market crash. Again, same thing. If I go from the low to the high where the market was, I see right now a 58% drop in the market. Now that was a little bit bigger than the one in 2000. Duration, about a year and a half, so similar to the other one, maybe slightly shorter. But again, let's see how long it took to recover. I'm going to go ahead and draw that same trend line in to the right now. All right, and let's do the same thing we did. We'll edit it real quick, give it an extension to the right, turn that on, and then make that just a little bit bigger. Put that at 2. And let's see how long it took to recover from this. Well, that's 2007. Let's keep going to the right. Well, it wasn't until, it looks like 2013 for that market to recover. That took 6-7 years, something in that range. So again, now we had a good idea of how those things work in terms of duration and degree. One other thing we can also see is that when we look at the simple moving average, you can see that sometimes it tends to act potentially as support and resistance. You can see once it moves above, it tends to use that as a support sort of framework, and again, sometimes when it drops below, it can be a little bit of a resistance. So sometimes people will look at that 200 moving average in addition to seeing how big the move was and how long it lasted. All right, well that wraps up our segment on getting historic views on market moves and using a moving average on the Thinkorswim charts. Now don't forget, if you want more information on these tools or other great education, visit the Education Center on tdameritrade.com. Welcome back to Virtual Trade. I'm joined by a new trader, Jenny Horne. Jenny, welcome back to the show.
Thanks, Scott.
Great to have you.
It's great to be here again.
Well, Jenny, we're going to have some fun today. We're going to be talking a little bit about measuring your exposure that you might have in a portfolio.
Great. I really know nothing about this, so I have a lot to learn, I think.
Okay, so we built the portfolio. Now the question is, how much exposure do we have to market moves? And in addition to that, Jenny, we want to talk a little bit about the makeup of the stocks in your portfolio. In other words, get an idea how much they move relative to the market itself. Does that make sense?
Yes, that sounds super important too, because
Okay.
I know that the overall market movement is something that people watch a lot.
Good. All right, well, let's get started. What we'll do first is let's jump in from the Monitor tab. We'll go right into the Market Watch tab, Jenny. And once we get in there, we're going to go ahead and go to the Quotes tab, which we're already on.
Great.
And perfect. I can see already we're looking at our positions. Now, before we go there, let me just show everybody how we got here, Jenny. I'm going to click here, and you have all sorts of choices of what you put in terms of watch list. And of course, we have our personals as well. But we want to look at the actual positions in the account. That's why we chose all positions.
Right. Okay, that makes sense.
Okay, so what we're going to do now is get an idea of how our stocks move relative to the market itself.
Okay.
And what that's going to involve is something called betas. And we'll get into the explanation of what that is in just a minute, but we need to first add the column beta to our watch list. So Jenny, let's go to the little icon on the far right there and go ahead and down just a little bit. No, it's like a gear, it's a round gear. There you go, you're right on it. And then hit customize. And then what we're going to do is look for the column header beta. And you can either just type it in, that's sometimes the easiest way. All right, actually go to the one below that, just the regular beta, perfect. All right, so now we have that in, and we can hit OK, and that will open up our new list with beta. Now beta, I'm going to grab the mouse, Jenny, just to bring it over a little bit so we can see beta. Now, if you'd like to take any column like the one we just added to the right here, Jenny, watch what I'll do. I'll click on that column header. I can drag this all the way. I'll put it right next to last, so it's very easy for us to see within our watch list right here. And if you can just grab that, we'll widen it out a little bit. Now we can see the beta a little more clearly on that chart.
Okay, now Scott, I know you briefly explained it, but what exactly is beta?
Okay, now this is an important concept. Beta is one of the Greeks that we'll be talking about in future episodes, but right now we want to talk about how beta pertains to stocks. And I think the easiest way is to think about beta as the sensitivity that an individual stock has to the market itself. In other words, it sort of measures the volatility of an individual stock compared to the volatility of, let's say, the S&P 500.
Okay, wow. So is this something that traders watch to predict the future of the stock, or how does this what does this relate to our companies exactly?
Well, what it does is it sort of measures the risk of each individual stock to market moves, right? So if we can go back and historically determine how a stock moves compared to the market itself, we'll get an idea of which of our stocks, or which of the stocks in Jenny's portfolio, tend to move about the same as the market, more than the market, or actually less than the market moves.
Okay, wow, so this number is constantly changing.
It is changing. It's built on historic information. So it goes back, let's just pick a number like a year, right? So it goes back over the year, looks at all the market moves on a daily basis, how much that individual stock moved compared to those moves, and it says over time, is that stock moving more or less than the market on an average daily basis?
Okay, wow, I can see how that's really very important.
So, like I said, it kind of measures your systematic risk. You know, how much risk, if the market's moving up and all my stocks move more than the market, well, I might expect to see a bigger move in my portfolio.
Right, like you hear these words like sell-off. Is this stock going to be affected by the sell-off, or is it not going to really change as much?
Great point, Jenny, because it works both ways. So if I have a portfolio that has lots of high beta compared to the market, if the market sells off, my stocks could sell off quicker or faster than the market itself.
That makes sense.
All right, so it works both ways, right? All right, so let's take a look at these beta numbers you can see in the column. Now, let's get a sort of a reference point of how this works. If the beta is 1, that means that the stock moves about the same as the market itself.
Okay.
Now, if it's above 1, that means the stock is moving in more, in greater amounts than the market itself.
Right.
And if it's below 1, that means, guess what? It's not even moving as much as the market itself.
So could I say anything over 1 is more volatile?
Yeah, absolutely.
Okay.
Compared to the market itself, absolutely. Right. 'Cause that's what we're doing, sort of comparing individual stocks to the market in general.
Okay.
So that's important to know which stocks, and you can see there's quite an array here. Before we jump into individual stocks, let me just start off with something like, I know we have Verizon, for example. I'm going to take a look at that one. And you can see that's 0.59?
0.69, right.
Okay, 0.69. Let's look at Exelon, which is our other stock that's a utility stock. Do you see that one in there?
That one's
right here. 0.16. All right, so you can see that sort of these stocks like telecom and utilities, particularly utilities, have a lower beta than the market. In other words, the market might be moving up and down quite a bit, but the utility stocks really aren't. They're just moving a little bit while the market's moving all over the place. So
now, why is that? Just because the sector doesn't move as much?
Right. Well, typically utility stocks don't historically move a lot. They're fairly consistent in the underlying product, like electricity or gas or whatever these things are. They're being provided, and they don't tend to fluctuate as much unless there's big price movements. But outside of that, those companies tend to sort of move along at a fairly even keel, if you will.
Okay.
Right?
Yeah.
Okay. So now, what kind of stocks would pop in your mind, Jenny? The stocks that do tend to move a lot.
I would say any technology, like the FANG stocks.
Perfect. FANG stocks, exactly. So if we look at some of the FANG stocks that we have, or something like Microsoft, 1.14, so that's definitely a little bit higher. Apple, 1.14. You're absolutely right. It appears that these stocks tend to move a little bit more or have a higher beta than 1.
That makes sense. I mean, you're always hearing about those making big swings, so I just assumed.
Exactly. All right, so let's just pick a couple out here, and you can see, what those stocks are doing, and you can sort of quickly notice: are there any stocks in our portfolio that seem to have a pretty high beta right now?
Yes, Diebold seems pretty high.
1.9.
Weight Watchers is very high.
Yes.
Wow.
Absolutely. So
much higher than pretty much anyone, actually.
Right. And so what that's telling us is that these stocks are moving. They have a high volatility number right now. So in other words, do they have more risk to the market? Well, they'll have more exposure because they're moving up more than the market and also down. So in a down move, absolutely, they have a little more downside risk.
So their high number doesn't necessarily mean a good thing.
Right. Exactly. Do you want to just be aware of what kind of exposure you have if the market should be moving?
Right.
I think it's also important to know when you're looking at a stock like Diebold. Now remember, this is a $10 or $11 stock at this point, and to have a 1% move, that stock only needs to move 10 cents.
Wow, right. Versus like an Apple, where to have that move, you have to grow much more than just $1.
Right. To get a 1% move, you might need maybe a $1.50, a $2 move for that stock. So remember what we're doing. We're comparing these kinds of moves in the stock to the moves in the market. So if you think about the S&P 500, how many days does it move 1%? Not that often. I mean, it can, and there could be times when market volatility is high.
Right.
But it tends not to move that all the time to see a 1% move, whereas these stocks, we're seeing a 1% move fairly often, even though it might just be a $10 stock.
Okay.
All right. So that's a good idea of how that works in terms of those particular stocks. What I'd like to do now is get a little bit of idea of the exposure we have to the stocks in the market. So what we're going to do is add delta. Let's jump into the monitor tab and add delta, because now we can look at our individual stocks, because I want to get you to see the idea of how much market exposure we have if the market moves up or down. So we'll add delta in there. Perfect. We'll hit OK. And as a matter of fact, do we see it? It's right there. Now, you're probably going to ask, what is delta?
Yeah. Similar to beta, I don't know what delta is.
Perfect. Perfect question. Delta gives us an exposure or an idea how much exposure we have in the marketplace for this particular portfolio.
Okay.
And delta is basically, in terms of definition, it's how much does the price of your stock change for a change in delta. Now, delta really applies more to options than it does to stocks, and it's very simple with stocks. For every $1 move in the stock, you get a $1 move, or a 1 delta. There's a 1 delta for every $1 move in the stock. So it's pretty easy to keep delta and shares almost on an equal level, if you will.
Okay.
So let's take a look. If you look at your delta here, and we know that you have, for example, 25 shares of Apple, we'll take a look. That's 25 deltas.
Oh, right. Wow, that's easy.
Right? So for every $1 move, you should make or lose $25. Now, look at that total at the very bottom of our delta. Let's widen that out just a little bit if we can. Actually, I don't think we can do that. But it looks like we have about 1,315 delta, or 1,315 shares.
Okay, right. So that's just delta to shares. That's pretty easy conversion.
Exactly. And as a matter of fact, if you think about this, Jenny, if every stock in our portfolio were to move up $1, our portfolio would be up $1,315.
Okay, that's a good way to look at it.
Sure, because we have 1,315 shares.
That doesn't sound too bad.
It can work both ways. If every one of our stocks went down exactly $1, down $1,
we could be down $1,300.
We'd be down $1,315.
Okay.
All right. Now, that is the total delta exposure. But I'm going to have you do something, Jenny. Come up here and click on where it says beta weighting. Because what we'd like to do with this stock, or this portfolio, your portfolio, is say that, okay, let's change the deltas or convert all the deltas of our individual stocks into a benchmark or one indice. And we'll use the S&P 500 to do that.
Okay.
All right. Now let's go ahead and put in SPX. All right. So now that's what is that? That's the S&P 500. Now, Jenny, go back and look at your deltas at the very bottom. How many deltas do we have now that we beta weighted?
Oh, only 32.
32.
Wow, that went down a lot.
Yeah, well, guess what we did? We turned those in, basically, we turned those into the equivalent number of shares or delta of SPX. So now that whole portfolio, in terms of SPX, would be the equivalent of 32 shares, or almost 33 shares. We'll just round it, okay? So here's the interesting thing. Now that we look at the SPX, which if we go to the chart, we can see the SPX is the S&P 500. And you can see it's a pretty big number. It's 2,800 at this particular time.
Right.
2,800. Now, what that means is for every $1 move in the SPX, and you can see today it's already moved several points, for every $1 move, our portfolio should be making or losing about $33.
Which is less substantial than 1,300, but that makes sense.
Absolutely. Yeah. So if you want to go ahead and look at the exposure your portfolio has, and you want to say, well, let's compare that to the S&P 500, again, by clicking on beta weighting, adding that symbol, you can now see that you have the equivalent, if you will, of 33 shares of SPX.
Okay, wow.
So then we can kind of look at the SPX and say, all right, if we have the SPX, which you can see is down 10 today, our portfolio should be down about, what, $330, $340, something like that.
Okay, so you can just take that number and multiply it by the net change of the SPX.
Exactly. $10 times about $33, about $330.
Okay, so that can kind of make you track like the day's losses or gains. Right,
and the last thing I'd say, Jenny, is if you have a portfolio that more closely resembles the NASDAQ, well then you'd probably use NDX. And if you had something that more closely resembled the Russell 2000, then maybe something like RUT.
That's great.
All right. So Jenny, how'd you like this session?
This is great. Beta and delta, I think, sound very intimidating if you don't know what they are. They just sound like Greek letters, but this was a really good way to kind of put context to those names.
Yeah, and see how they pertain to your portfolio.
Exactly.
All right, well, Jenny, this was a lot of fun. Thanks for joining.
Thanks, Scott.
In this episode, we examine different types of market downturns, as well as some ways that technical analysis can help us identify and navigate them. We also explored past downturns that some of us remember all too well. And finally, Jenny Horne considered the risk present in her new portfolio. I'm Scott Connor, and thanks for watching Virtual Trade.